Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, the regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining us for this segment, we have Steve Wyett, Chief Investment Strategist at BOK Financial. We're here to discuss the impact of the government shutdown and how patient the market will be with AI spend. Steve, it's great to see you as always. Welcome back to Trade Talks, and we have a number of issues to get through just besides the government and AI spend. But I do want to start with the government shutdown and what the impact could realistically be as we start to see it unwind, hopefully at this point.
Yeah, look, I'm glad we're having this conversation this morning when it does appear there's some progress being made towards getting the government reopened. The pain from that was really starting to ratchet up, Jill, as you know, not just with travel and airlines, but really SNAP benefits. I think that when we started messing around with the SNAP benefits, that's when the political pressure really started to ratchet up. And so it's not surprising that we've seen some movement there. But I don't know that it's one of these, like most of them, neither side's going to be able to declare a complete victory. But as we move past this, Jill, I will say this. The pain of the shutdown was getting worse. But as we get past it, I think we can recover from that pretty quickly. And so we'll get people's back pay. That's going to be part of the agreement. We're going to probably see some movement to where some of those furloughs that turned into actual job losses are rescinded and those jobs come back. But as we get through that and look into 2026 and 27, I've got to tell you, we're a lot more optimistic about how the economy looks going into the first quarter of next year. So hopefully we can get past this. I think it just put everybody in a grumpy mood. It's just not what we wanted to walk in and see every day. And those of us that travel a lot, I'm supposed to be on the road today. I've already gotten notification that my flight is delayed, even though Tulsa, which is where I am, our airport is not directly impacted, but the top 40 airports across the country are, and that's where all the planes come into Tulsa from anyway. So hopefully we can get this settled on a relatively short-term basis.
And Steve, speaking of fortuitous timing and having you on with us this afternoon, I want to discuss the 50-year mortgage that the Trump administration is bringing forth. And I understand it because I think the larger conversation when we think about the economy is affordability overall.
Yep.
But there are pros and cons to the 50-year mortgage, right? Of course, in theory, it could be more affordable, right? But then you're paying more interest at the end of the day. It's going to take longer to build equity. Perhaps that could push up prices because more demand will be there if there's not enough supply. So there definitely are pros, but we also have to think about the cons as well.
Yeah, Jill, look, affordability, like you said, we've talked about housing quite a bit on our calls over the last few months. At its base, this is a supply issue. It's not necessarily a demand issue. There's quite a bit of demand right under the surface if rates would fall a little bit, if home prices would just flatten out and let incomes catch up. I know the concept of lower home prices, that might be good for people that are trying to get into the housing market. That's not necessarily good for those that currently own their homes. But this 50-year mortgage idea, it is something that we've actually been kicking around for the last month or so internally here. One person in particular in our organization has been pressing on this because of the affordability, reducing the size of the monthly payment. And they pointed out, look, we've been doing this in other areas, Jill. Remember, it wasn't that long ago that 5 years was the longest car loan you could get. We're now out to as long as 9-year financing on some car loans out there just because the price of cars, I think the average price is up to around $50,000 now. But you're just seeing that as a way to become more affordable. It means that you've got people upside down on car loans for a pretty fair amount of time as we work through that. And so these are the risks. I think the key aspect for me, as I think about the 50-year mortgage, is going to be the willingness of the market to support that 50-year mortgage in the securitization market, whether or not we get Fannie Mae, Freddie Mac, Ginnie Mae behind that, and then whether the market will support that, if it will be willing to buy enough of those mortgages to fund the lending at that term and make that a liquid enough market. If the bond market won't support that, it's not going to fly. I mean, you're correct. There are reasons that you pay a lot more interest, but that's true of a 15-year mortgage versus a 30-year mortgage. And so I think it's just, I'll give them credit for this, trying to think a little bit outside the box, but you're going to count on some things staying the same. My question would be, do you price it off the 10-year or the 30-year? Do you need to, when the 30-year is trading at a higher yield than the 10-year, will investors demand a little bit higher spread because it's longer? That could really, those two factors alone could outweigh the benefit of spreading the principal payment from 30 to 50 years. So there's a lot of moving parts there. I give them credit for trying to think of something outside the box. I'm not sure that's the solution that's going to make the housing market really move forward faster, but give them credit for trying to come up with some idea that might help.
Right. And Steve, you brought up a great point. I mean, 15 years to 30 years, you always have the option to refi as well if you're looking to access liquidity or build your liquidity quicker. Or if you're a first-time home buyer, in theory, you're a little bit younger. As your career progresses, you most likely will be making more money as well. So there is the option to refinance at some point as well. Speaking of spend, I want to talk about AI spend because it seems to be the market is getting a little bit impatient getting this ROI and figuring out what that's going to look like and how, enterprises are going to use AI.
Yeah, so I think that as we went through some of the sell-off last week, there was, it was from our lens, there's no doubt that the AI trade, and I'm going to move that beyond the hyperscalers to a lot of stuff that's been going on in the energy markets as well, nuclear, some of those names, man, they've had just unbelievable moves, bigger than the hyperscalers themselves. And so I think the psychology of the market last week, people just got a little bit grumpy. The uncertainty of the shutdown was growing. Both sides seemed pretty intractable. And so if I'm an investor and I've had this tremendous run in these markets over a short period of time, probably the prudent thing is to look at taking some of those gains. You can always come back to that trade at some point in the future, but you just don't want to sit there and watch some of this stuff fritter away. So I think that was some of what's going on. But I do think longer term, Jill, this is where the idea of the patience of the market, where these investments start turning into returns. Lower interest rates could help that. That helps reduce the opportunity cost, if you will, of seeing that money stay invested for a longer period of time without a return. But I think that it would be naive to believe that every one of these investments is going to turn out to be a great deal. There's going to be some winners and losers. And I think that over the next 12 to 18 months, this is when the market's going to start to try and discern between which of these are going to be the winners and which are going to be the losers. And you'll start to see some differences in the performance of those individual companies based on that assessment.
And finally, Steve, I want to bring up demographics for a moment because this is a theme that you've been focused on for quite some time now when we think about the shrinking labor force and Social Security, right? That's not exactly the best mix. So what are your thoughts there?
Jill, this is, as you're right, I've been thinking about immigration as probably our biggest challenge and our biggest opportunity. It's just really interesting to me that we've got a number of tax breaks coming at companies to try and incent building of plant and equipment and move production back to the U.S. At the same time, our immigration policy is becoming much more restrictive, and construction is the sector of the economy with the biggest percentage of employees there from an undocumented immigrant standpoint. So we could be looking at a scenario where we're actually increasing the demand for that labor, even as we're shrinking that labor pool. But here's the other bigger issue from that standpoint. We know the Social Security system is spending down its surplus. Now we got an update last year from the Social Security Administration that somewhere around 2032, it's not that far in the future, we're going to spend down that Social Security surplus. If we start to shrink the labor force, Jill, that's going to happen even faster than what we had thought. So I think there are some implications around this. And again, this is why I say it's a real opportunity. If we can get Congress to move immigration out of the political arena and more into an economic discussion and understand that this is really about economic growth going forward. It has potential impacts, huge impacts on our level of indebtedness. We're already at $38 trillion. We need policies to help us grow. And so we don't need a shrinking labor force. We need an expanding labor force. It's not just our debt situation. It does impact our entitlement programs. There's multiple ways to look at this that I think if I'm in Congress, man, if we can just influence our congressman in some way to quit listening to the wings of each party, this wide open borders or mass deportation, and get into the middle ground where we need an immigration policy that will help us grow the economy, that's going to be better for us all. I just hope that maybe we get past some of the stuff that's right in front of us and we can start paying a little more attention to some things that impact every one of us, regardless of our political stripes, by the way.
Yep. Appreciate the insight as always, Steve. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you, Jill.